Thank you all for being here at our summit. I'm Brian Connolly, and on behalf of all of my partners at DLA Piper, I want to thank you for being here today and thank our panelists who are going to lead our discussion today on redevelopment and repositioning, innovative opportunities and development. It's going to be a great discussion, I know, from the prep sessions we had. So I'm going to start by introducing our moderator, Mary Rotler, the Chief Operating Officer at First Washington Realty.
Excellent. Thank you, Brian.
Thank you, Mary.
Excited to be here. Okay. I don't know what this, there we go. Yeah. It was an amazing lunch, right, session. So following that, I'm excited to see what these guys can do. So we're going to start there, setting the bar even higher than what we had expected. So I'm going to let each of them introduce themselves. I think they'll do a much better job than I will and explain why you should listen to any guidance, advice, or insights from each of them. A little bit about myself first. So as Brian said, I'm the CEO at First Washington Realty. We're based out of Bethesda, Maryland. We primarily invest in grocery-anchored shopping centers. We've been growing quite a bit lately. Recently acquired Donahue Schreiber out on the West Coast, which DLA worked with us on. And I'm really excited to be here talking about innovative development. Prior to joining First Washington, I was at Seritage Growth Properties, which was known as the Sears spinoff and REIT, converting retail Sears into other retail and alternative uses. Okay, so with that, Omar.
Omar Tawfiq, I'm a managing director at Hines. I'm the fund manager for the Hines Global Income Trust. It's our $3 billion global non-traded REIT. We're in over 14 countries in all 4 major food groups, doing a lot of acquisitions, ground-up development, and redevelopment within the fund. And of course, Hines as a firm is active in over 23 different countries now and 4,500 people, again, doing much of the same things at a much larger scale.
Excellent. David?
Okay, we're going to bypass.
I'm just jumping around.
Great, no problem.
This is how it's going to start.
I'm David Riefman. I am the president of the Chicago business unit of Clayco, which is a $5 billion a year construction, real estate development, design, build, architecture firm headquartered here in Chicago. I'm also a partner in CRG, which is our real estate investment group. Prior to that, I was the Commissioner of Planning and Development for the City of Chicago under Mayor Emanuel. And prior to that, I was a partner at DLA Piper.
Excellent. Keating.
Keating Crown, managing principal at Sterling Bay, based here in Chicago. About $5 billion under management. If you asked me 3 years ago what markets we are in and what we did, I'd say we were a Chicago office developer and happen to have projects in Portland and Wynwood. I think there's been enough talk about institutional feeling about Chicago office over the last day. So over the last 3 years, we've expanded both in food groups into life science, multifamily, and industrial. And now we're in 13 markets, heavy presence over the last 2 years in San Diego, life science, as well as Boulder, and then into the Sun Belt. And a little bit smaller, but aspirational to what Omar does.
Excellent. I think what's really exciting about this group of panelists today is just the breadth of the industries that they cover. One of our objectives here is to be able to give you something new that you haven't heard today, which going into the afternoon session will be quite the challenge. So I'm not going to repeat the office statistics that Mitchell already took away and I had to cross out earlier. So this is going to be a little bit fun as we decide some different directions that we want to go in. Okay. Good. So I think part of it is looking at the title, right? Innovative development. So what does that mean in today's world, given all of the headwinds that we have in the development? So Keating, I wanted to start with you. So when you think about innovative development, right, what projects, what actually criteria fit that description?
Well, I think what we're trying to do, and I think most office developers are, is help our tenants bring their employees back to the office. Obviously, there's been an amenity race for some years now, but we're seeing tenants who we're negotiating with get very specific and very involved on what those amenities are in their space and in the building, and then down to giving us a very short list of F&B operators that they want to see in that project or in a project next door or in the neighborhood. So just this effort to bring people back to the business core and into the building. And it's going to remain amenity-based, but it's not just in the building, it's the entire neighborhood. And we talked a little bit about Fulton Market before, and that's why Fulton has been so successful as of late, and also over the last 10 years, is the opportunity to have 24/7 amenities and opportunities for employees, not just sit at their desks, but get out and do something else.
What do you think, Omar?
Yeah, no, I echo a lot of what Keating said. I think Hines, as you all know, for the last 40, 50 years has been a prolific developer of large urban CBD office towers. And I think over the last 5 to 10 years, that attitude has changed, and we saw the tide shifting. And not only can office needs to be redefined in and of itself, but placemaking is now so much more important than it was 10 years ago. And being able to not only live, work, play, but a fourth word, connect. And I think integrating those 4 now into your developments is going to be just very critical in terms of redefining place, attracting the highest caliber tenancy, and then also, similar to Keating, we're increasingly not only having those conversations earlier on with the tenant, but now there's an ESG component to it as well, which I think is influencing our placemaking and our developments in a much more significant way than they were 10 years ago.
Well, first of all, we're also very involved in Fulton and have a big project going on there right now. I think another way we can talk about innovation and development is the way we control the process. So for a company like ours that has really every aspect of the process in-house, if we need it, we can begin through the design-build process and the architectural process to get better cost control, get better purchasing, better buy out our trades earlier in the process, know what we're going to build, and move much quicker as an organization. I think that gives us a little bit of an ability to manage some of the challenges we have right here. But I would also say, in terms of the project we're developing in Fulton right now at 170 North Green, it's the differentiation of different asset classes in the same project, bringing different amenities, doing the things that tenants are expecting. And, we're all here. If you walk around Fulton right now, that is the bright spot of the commercial real estate world here in Chicago.
And I'd just add that you're starting to see tenants pay for it. Rents have moved. I mean, 9 years ago when we did the Google deal at 1K Fulton and Fulton Market, they were low 20s net. Rents have moved into the mid 40s, and I think that they're looking towards the high 40s. Obviously, there's been the movement in construction pricing and materials, which is part of that. And if they want to make the move and make a big move, they're going to have to pay for it. But being in and I hate to dump all over LaSalle Street, but it's a tough sell right now, obviously. And to have those amenities, tenants are realizing that they're willing to pay for them.
So I think that goes into kind of what, if you're the owner of one of those office buildings on LaSalle, right? What are your options, right? As we're talking about repositioning, right? Is it just to drop the rent? Is it to build a One Vanderbilt, right, in New York City, where you can command those type of rents? What are the choices that you're seeing from a repositioning perspective?
Well, LaSalle Street's an extremely difficult problem for the city and for us. I mean, I don't think the answer is going to be the same in every city. New York, you can take an older building like Chase we were just talking about, where you can literally take down your existing building and build a brand new Class A office tower. New York's uniquely situated in that way. There's been a lot of talk of different things that could happen on LaSalle Street, including housing and affordable housing. I think the city would be interested in trying to help do more affordable housing with different projects. But I think it's extremely challenging what happens with LaSalle Street. And when you look at the city today and how empty it is, the LaSalle is very noticeable. So maybe more Class B office, maybe there's other tenants that can go there. Clearly the Class A are going towards the river in Chicago and towards Fulton. So I see that as one of the city's biggest challenges, and I know they do as well.
Yeah. And it's not unique to Chicago, right? Every city has their...
Every city has their LaSalle Street. Although Fulton Market, as one of the very hottest submarkets in the United States, does put pressure on the traditional central business district here in Chicago. I couldn't tell you exactly how that plays out in San Francisco or Los Angeles.
But I think then, to your point, that we're spending a lot of time talking on office. Where are the markets that you know, as an investor, right, as an owner, want to continue to invest in, right, that you see the long-term potential? And where are there markets that, you know, you've taken a step back?
Yes, I think from a Hines perspective, we're really long on European build-to-rent as both a ground-up development and redevelopment and repositioning play. There's 4 million plus renters that live in what's called, you know, the buy-to-let or your Victorian area townhome in the UK, and it's basically a flat. There's only 160,000 residential units delivered in what we consider Class A multifamily, what they call build-to-rent in the UK. So there's 160,000 Class A units delivered last year, and there's 4 million people living in 100-year-old flats that are not energy efficient. So there's really two great tailwinds there. One, there's a tailwind for the UK resident to improve their quality of life and upgrade into Class A space, which Hines or another developer can provide. But what's also going to happen over the next 10 to 20 years is a massive redevelopment of these Victorian townhomes and flats and repurposing. And there's already large private equity groups that are accumulating these in blocks for the next repositioning of a neighborhood. And you're going to see that kind of filter out throughout London. But it's really amazing that the build-to-rent sector is just taking off there. And the reason for that is, up until about 5 years ago, you can get a 105% mortgage in the UK. You give 100% to buy your house, and then you get 5% to upgrade and improve it. And we're all sitting here being like, that's absolutely crazy, which it is. And then lenders there realize that, and they stop doing that. But even the mortgage market there is different. They do 5-year mortgages, we do 30. But the mindset has completely shifted. And so you're seeing this proliferation, can't say that word, of build-to-rent housing. And then you follow on build-to-rent, which is expanding in the UK and Europe, which is extremely difficult to build ground-up new development over there. So a lot of what we're doing is redevelopment and repurposing of buildings, and it's a lot of adaptive reuse. And then following multifamily comes self-storage, and they almost like track each other. So we're very bullish on multifamily and kind of self-storage globally as these new built-to-rent or multifamily sectors pop up in what is established markets, but emerging sectors for them.
You know, I'd say by no means are we abandoning Chicago. We feel very strongly about our land at Fulton Market, in Fulton Market, and in Lincoln Yards. And we're going to spend another $5 billion at a minimum on those projects. But I'd say we're focused where it's very easy to do business, and where we have cities calling us and asking us to come and do what we've done in Chicago in some of these other markets. And you know, in Durham and Charlotte, in Atlanta and Dallas, we have a project we're under contract for in Durham, and within a week of asking the city if we could get together and talk about some of the aspects of the project, we had 10 people on a Zoom asking to help us, asking us what else they can do. And you know, that's refreshing, but it takes some of the risk out of the deal. And then also, most of these markets, taxes are a fraction of what they are here. And so the ease of doing business with the city, young people continuing to move there, and beneficial taxes.
You know, I think we also have similar strategies. So, you know, Clayco is a national builder. CRG is we're mostly in the United States. We do a lot of inbound, but all of our work is in the domestic United States. But again, our multifamily platform is in the Southwest, in Phoenix area. We're seeing a lot of growth there. A lot of Chicago developers are actually there. We're building. We see secondary markets like Charlotte, Nashville, other places where multifamily is particularly strong. From an industrial perspective, we've had a great run over the last few years, like every other industrial developer has, but we've located, we have key locations throughout the country. We have a Northeast, we have a Southeast, Southwest, Midwest, and Northwest. We've really tried to cover the entire map on industrial. I think there are opportunities here in the Midwest and Chicago still, as a Chicago-based company, but our opportunities are national, just like Sterling Bay and Hines.
So David, I think it's interesting that your background and experience, right? You've sat on the legal side, you've sat on the public side, and then now you're on the private side. How do you see, right, the role of local government officials, municipalities playing in with the readaptive just development overall? And I think it's
well, as every real estate developer knows, you have to deal with government, you have to deal with municipalities. I think in our administration, certainly we tried to attract as much growth as possible. Chicago is a global city. We recruited headquarters. I think in fairness in the current situation, there's been a lot of every city, we've talked about this already today, has experienced significant challenges, both in terms of the impact of COVID policies and COVID on our cities and our back to the office and our businesses, as well as racial justice issues. All these things have created a lot of headwinds for us to make progress in cities. I think when you have a project like Lincoln Yards, or you have a project like the 78, or much smaller projects everywhere in the city, you need government to really try to be a partner to make those things happen. It's in the interest for job creation from the government side, for job creation, for taxes, all those things that the public needs out of private development are always relevant. So I would say you have to have good government partners, and people try their best to accomplish that.
Of course, I was putting David in the category of extremely easy to deal with. And our conversations never ended with an argument or a phone slammed.
We had some screaming matches. We did, and it all worked for the best for better projects in a better city. That's our objective.
It's fantastic. That sounds like a wonderful relationship between the two of you. So it's fantastic.
It remains.
I think when I'm hearing you say, right, Keating and Omar, we've touched a little bit on this as well, is that when you're looking at the investment opportunities, right, the ease of doing business and the ability to move forward to be able to de-risk the project, right? Because there's already risk, right, that we're facing with the different headwinds of doing development, right? These are not acquiring stabilized assets, right? This is long-term vision, partners, right, public-private, whatever it may be. How much does that factor into it? Because we've talked about, obviously the office, right? Back to the office work in certain states is at a much higher than they are in some of the traditional CBDs. As I'm looking at this lovely photo of Bryant Park and New York City, where there's not the same level of back to the office, right? How does that location and that risk profile fit into your investment decisions?
I mean, certainly the location. It's a little bit of how I answered the previous question about Durham and Charlotte and Dallas and Atlanta, and to a certain extent Wynwood and Miami. But you're exactly right. There are already too many risks, and layer on the debt markets where they are right now. And we've had a couple projects where there's been a party of one or maybe a party of two showing up for ground up development. And so it's, when you stack these risks on top of each other, and we have our partners and hopefully our lenders on these projects, they're ultra focused on the risks. So if you can take some of that off the table, and if you do have a municipality that you can work hand in hand with, it's just an additional layer that can be removed, or there's a little bit of life's too short to focus too much, especially if you have a lot of development and ground up development. And we don't buy much stabilized or light touch repositionings. And so when you have that many projects coming out of the ground at any given time, at least for a company of our size, in the 150 people range, it falls in the category of not life's too short, but let's go where we know we're going to be able to execute.
Resources, right? And that's a lot of different types of resources. Omar, what about you and Hines?
So I think at Hines, we have the benefit of two things. One, just time in a lot of our markets, right? So we have 50 to 60 year relationships with these municipalities, which has helped a lot. And then two, we're in multi-disciplines, and so we're constantly not just talking to them about an office development, or a multifamily, but now we're in industrial, life science, self-storage, retail, so we're mixed-use development. So we're really running the gamut, and we've got multiple channels into the municipalities for a variety of things at all times. So that's helped a lot. And two, we've obviously we started off in Houston, which you can have like a gun store, church, kindergarten like in a row, and that I think has kind of spoiled us in some ways. We've done some of our largest scale developments there, and going from that environment to a Chicago or to a London or to California and working on land entitlements in the Inland Empire is not that. And so I think it was an evolutionary process for us as a firm to get to where we are today. And I think some of those growing pains and lessons learned from other parts of the country we're able to translate over into new markets that we're entering in and learn from.
Can I say something else about this topic? I mean, I certainly, and our organization certainly understands when you want to go into a market that is easier to develop and the entitlement environment may be simpler. I mean, I think that's something that's always a choice, and many Chicago developers, for example, have made that choice to do a lot of things elsewhere. But you also have to look at the situation in Chicago is, more or less comparable to the situation in New York and Boston, San Francisco, Los Angeles, every major city, and these are major cities for a reason. Chicago alone has $14 billion of real estate, construction, annually, or did. And there are huge populations and huge wealth and huge, spending and things like that. I don't think you can just simply state at some level Chicago and New York and everyone's going to bypass those for real estate development. But what I think you do have to start doing is being, and I think this is our experience, I know it's Hines' experience, I know it's Sterling Bay's experience, that you have to be more proactive in how you address the issues of entitlement to navigate them successfully. Affordable housing is going to be an issue in every major city. Workforce and minority and contracting and venturing and wealth creation is always going to be an issue in every single city. So you have to come up with tools and be proactive and creative in how you address those, and I think those are parts of the solution. I mean, I really know Chicago the best, obviously, but I still see the tremendous potential of Chicago, and not just Fulton Market. The Obama Center is going in on the south side of Chicago. That has the opportunity to spur significant growth. The entire South Lakefront has potential. There are areas throughout the city, the Illinois Medical District, other places where investment through institutions, the University of Chicago, Northwestern, we look at these assets. I don't know what some of these smaller cities have, but you look at the assets in New York, Chicago, Los Angeles, San Francisco, Boston, those are the things that attract talent at the end of the day. We just have to navigate what I think is a very difficult time, but in the long run, I would say, I'm a little bearish on Chicago in the very short run, but I'm bullish on Chicago in the long run. I think this has tremendous potential, and Chicago's not going down. We want to go to Charlotte and make money too, right? We're here, we're going to do it, but I think all of us are committed to what big cities represent in the United States.
And I think the creative, fair entitlement tools are a huge benefit. And David had the Neighborhood Opportunity Fund, which they came up with that when he was at the city, which we used a ton, as a number of other developers. And yes, it's an additional tax on yourself, but one, it's doing good things. It's going to neighborhoods in the city that need the money, and it's not overly onerous. It's a fair calculation to get what the benefit is for that project. And then East Midtown, or you took advantage of what One Vanderbilt and J.P. Morgan did in New York. Those are fair programs that have huge benefits in the long run.
Yeah, I think simplistically saying that the key to the city's revitalization efforts, any cities, is going to be public-private partnership, and it's going to be at a variety of levels. And that public-private partnership, if executed well, is going to help revitalize LaSalle Street and do a lot of these office to living conversions, because we've looked at a ton of office to living conversions at Hines throughout the globe, and unless you're getting the building for darn near free, or you've got significant help from the city, they're really tough to do and hard to unlock. So I think that public-private partnership is really, it was a huge deal in the past, but it's going to be even more so in the future going forward.
And I think one of the things that it sounds great, right? If you've got a Class B office building, to be able to convert it to a higher and better use of adding in residential. But to your point, the practicality of that is very difficult to do. And I don't know, actually, I'm curious now, I'm just going to go off the cuff here. Does Hines have any really good examples that you could say, here's where it has worked?
Yeah, so we're doing one in Salt Lake City. We're very close partners with Gensler, and they've done some great work in Calgary. And so Calgary's office market went to basically 30% vacancy when oil prices tumbled. They're single sector economy. And the city went to Gensler and was like, look, how can we figure this out? Like, we have a huge problem here. We've got a lot of Class B buildings that aren't part of our raised elevated transit system. How do we fix this? And so they came up with this great scorecard of how to rank buildings on central core, window to core depths, floor to ceiling heights, location, and they came up with this really great weighted average matrix for Calgary, for the city. Again, example of public-private partnership, and they identified a handful of buildings where they can go in, execute redevelopment, and they actually mapped out multifamily units within these floor plates, and it was really interesting. So we took that and just our knowledge and working partnership with them, and we're actually doing it in a building in Salt Lake City right now, where we're doing an office to multifamily conversion. It's the first one that we're doing in the U.S., and it wasn't. That investment committee was one of the more rigorous investment committees that I've been a part of. But it's really exciting, but it was a challenge. Like, we kind of scoured our U.S. portfolio. You've got to have a willing seller to unlock the building at a really attractive price. You've got to have an entire kind of conceptual construction, MEP, entitlement team that's very different than a ground-up development team. You've got to have multidisciplines looking at this, multiple disciplines. And so it's not something that I think we can, every asset's unique. It's not something that we can take the Salt Lake City deal and copy-paste it into another. The environment, the building, and what you do with it is going to be, different every single time you do it. And I think that's some of the challenge there. There's certain lessons you can learn and reapply from one conversion to the next, but my gut says that they're each going to have their own story.
I would add to that, especially, in particular coming out of COVID, the interest in fresh air, the interest in personal or private outdoor space or access to outdoor space, both in our multifamily and in our office space. The ability to have your own outdoor space, or at a minimum common outdoor space within the building, be it office or multifamily, that's the space that's leasing. And and I'm not an architect, but to do that on some of these older, large floor plates, buildings that are 3 feet from one another in certain cases is really difficult. And so it's either going to cost a heck of a lot more, or you're going to have some leasing trouble because you're not. Even after you do everything and you go through a costly renovation and you bring in, up to state-of-the-art systems, access to that fresh air is likely a huge challenge.
I think we have, and again, I can only speak best about Chicago, but we have a number of excellent examples of the kind of redevelopment, reinvention, reuse on a large scale and a small scale. So if you look, I'll give a couple of examples, and I agree with the public-private partnership because that's essential to accomplish these things. But a lot of the origins of Sterling Bay's Lincoln Yards development begins with the transition of what were called planned manufacturing districts. This was 750 acres of heavy industrial, heavily restricted land use for manufacturing that was transitioned to allow mixed use, live, work, play, multifamily, single family, industrial, office, life science. All those things were transitioning former industrial buildings. The history of Fulton is the transition of a meatpacking district. The old post office, which is one of the 3 buildings in Chicago, is a massive example of a building that sat for 20 years and had to be really thought through in terms of its repurposing. And, timing is everything. Large floor plates, Walgreens, all those things happened at the same time to allow that to occur. So I think the 78, another large project that Related is doing here in Chicago. How do you take this property that was really kind of left, unused, and really rethink it? And I do think from a city like Chicago's perspective, these large tracts where we can transition things close to the central business district gives us tremendous opportunities for growth in the long run. We have many issues to get under control, but I think those are some significant examples of where you have really redeveloped a prior use in conjunction with whether it's zoning relief or tax increment financing or other public sector financing or creating a fee structure that you take upon the conversion of that land. We have an industrial fee here every time Sterling Bay converts land. They're going to have to pay a fee that supports industrial elsewhere in this, like wetlands credits, for lack of a better term. So I do think there are great examples of how you adapt and take what was here and transition it as the market transitions.
And I think it's interesting, right, looking at the kind of that historical reference, right? So where you have former industrial buildings 100 years ago, which became really expensive lofts, right? Because they had the character, high ceilings, whatever it may be. And so there is some of those examples, right, that just depending on the ebbs and flows of real estate in the market that are a part of it.
People love authenticity. I mean, the thing about Fulton Market, it was a big fight, is it is anchored by a landmark district. All the development that, Sterling Bay did one of the biggest adaptive reuses there for Google. They took an old cold storage building and completely transitioned it into Google's main building here in Chicago. But you built that around the bones of, why do people like Fulton? It's not because of all the new buildings that are going up necessarily. It's the character of the streets, the area, the older buildings that are there. You really took something that was there and transitioned it. So like the loft you're talking about, people crave that authenticity.
And I think that goes into also the energy, right? In many of these areas that you bring those people together for different purposes. And, there's that secret mix, whatever it is, right? The authenticity, the reason you're there for restaurants, for work, live in those environments that are created. How do you see, right, again, going back a little bit into the work from home, flexibility, right? That either goes from you never have to come to an office again, right? Thank you, Airbnb, all the way into an environment, right, where people recognize that there should be a purpose, right, of gathering and what that looks like. So how do you see this work from home and the importance of like a Fulton playing into the decisions, right, for either people setting their policies or even understanding if it's a single headquarters or if it's going to be multiple locations right around?
I think we're seeing both employees and tenants vote with their feet on kind of where they want to go and where they want to be. And that's ultimately, the bottom line. I think we're building a new headquarters in downtown Houston called Texas Tower, and the leasing's going good, not great, in downtown Houston. If anyone knows it, it's not extremely well amenitized. It's got some, but not. I wouldn't call it a true live, work, play environment. We lost a couple tenants to this really boutique-y office building in an environment that is, I wouldn't call it a Fulton market, but it's an up-and-coming area. It had a little bit of edge to it. It had a presence to it. It had a story behind it. It had a lot of character. And I think it wasn't eye-opening to Hines that we lost those tenants to that location, but it was just more a sign of the times. The tenants are voting with their feet on where they want to be, and they're sacrificing, in some cases, the best, newest CBD building to be in a location that is not the CBD and does not represent the CBD and is almost disrupting it. And I think the employees of both Hines and a lot of other firms in Houston at least are going to continue to vote with their feet, in my opinion.
I always try to answer this question not to come across strictly as an office developer, because it definitely is biased. But I think there's a little bit of, we may have to cycle through some of these current millennials who don't want to come back. and get to whoever's next.
I'm Keaton.
But I think, if our portfolio was at about 4% early pandemic occupancy, we're getting into the 30s Tuesday through Thursday. Monday and Friday are still a little iffy. I also say, and this is more having young kids at home, siblings aren't meant to spend this much time together. At least mine aren't, my kids aren't. And then when you're in your little cohort with your friends from school, then the friends who don't live together but spend so much time together start acting like the siblings and they're fighting. I think there's a little bit of, we shouldn't necessarily be home with our spouses or significant others that much. And I love my wife. But I think people are starting to vote with their feet, and it's going to take a little bit of time. If our portfolio, and I think Nushin was on the panel before she had to cancel, and their portfolio is about the same. And you get into the 30s, Tuesday through Thursday. Unfortunately, I think we're coming back right into summer, and naturally that's when it slows down anyway. But assuming these variants aren't changing, I think if you can create the culture in your office. I mean, we've been in the office since May or June of 2020, and a lot of it's because of culture, and a lot of it's because when we built the McDonald's building here, McDonald's purposely built out their space. They do some hoteling, but they built areas where you can run into somebody, sit down for 2 minutes, and solve a problem. And the reality is, in most businesses, you're solving problems constantly, and scheduling a Zoom to solve something, to do pleasantries for the first 5 minutes, then 15 minutes of whatever, and then goodbyes for the last 5 minutes. It's really not efficient. Even though you can get people from around the world on a call together, being able to, if you have a culture where you can pop into someone's office, cube, run into them, and figure something out in a fraction of the time, office isn't going away. And I think slowly but surely, tenants are starting to vote with their feet.
Yeah, I think our firm is very similar to Sterling Bay. We've been in the office since June 2020. Our view is also we have 10,000 workers in the field. I mean, we have never grown faster as a company than we did during the last 2 years. And for 10,000 people on our workforce to be on the job every day, and for executives to be out of the office sitting behind their computers at home was not how you lead from the front. You get back into the office. But we're also big believers of getting people back into the office. It's beyond office rents. It's the entire energy of a city it's restaurants, it's entertainment, it's every interaction that occurs in a city needs that. And I do agree, I think we've talked about this quite a bit today. There's some balance, a day a week or something like that. But we're not about 2 days a week in the office. We're about maybe a day a week not in the office. Come downtown. One thing we've done to get people back downtown, by the way, is we buy lunch every single day for everyone in the office. And the way we do it, and you guys do something similar, the way we do it is we use a firm to buy from restaurants around the city so that we're supporting them with our lunch every day. But, for one thing, people are like, well, I can get free lunch at the office. I'm going to go in the office. And also, if you're in real estate, you can't necessarily do things on 11 by 17 monitors. You need to print things out. You need massive technology to function properly. But I'm really hoping, it's like 2 years ago, everyone said, oh, we'll never shake hands again. Well, we know that's not true. We all shake hands, and it went away very fast. People need to come back to the office. That's where you learn. That's where the culture is. That's where mentoring occurs. That's where ideas occur. That's where you're going to grow. Can you save a trip to the East Coast for a Zoom call? Yes, that's occasionally valuable. I think that is a good innovation. But beyond that, I think the workplace has to be revived and very, very quickly.
I hope so, because I think the ecosystem that we're all talking about, right, again, coming from more of the retail side of it, right, depends obviously on, in a lot of sectors, right, those office workers coming back, and it all just flows together. And then the energy that is created oftentimes is from the retail, right, at Fulton and other places, where you get that buzz because there's some of that. And you're seeing, I think, a lot of that starting to emerge, tourists coming back, like it all kind of builds together, which is part really exciting for these for the CBDs as well. So I think we're all I think we're bullish. That's it. Bearish short term, bullish long term, right? And again, if nothing else, it's just to get away from our spouses and kids is what I really heard, which I could not agree more. So, right?
Are we streaming this?
Yeah.
It's being recorded. We're going to send it to your wife.
Fantastic.
Right.
Send it to my wife.
Right, I love it. You're like, but I love you, honey. So it's great. So I think we've talked a little bit about teleworking. What does that look like? Talked about redeveloping. What are kind of some of the implications? Now we're going to say, look out, right? We've been building in this environment, trying to adapt as quickly as possible to the current needs based on what we know, right? Are we bigger? Are we smaller? We just know that, if from the session this morning, it'll be friction-free, touchless, more seamless, like things that we've been talking about in a long time in the hospitality world, in the retail world, right now coming into additional sectors. If you're looking out, how are you trying to future-proof, right, some of your developments? And what are some of the tips that you would give this audience? Share your trade secrets, basically.
This is going to be a little bit more global, but some of these cities, like I've mentioned, Durham, Charlotte, Atlanta, and some of the neighborhoods that we're going into, they're very much like Fulton Market, or Fulton Market 5 or 6 years ago. We're a little bit worried about the infrastructure and the ability to get, primarily sewer and water, because all of these projects that we do rely so heavily on sewer and water. And there's been so much growth in a handful of these submarkets so quickly that infrastructure is either compromised or doesn't have the capacity, or in not necessarily the markets that I just mentioned, or the city doesn't have the dough to pay for them. And that's where, you look at Chicago, Lincoln Yards. Yes, we went and we have a TIF to pay for the infrastructure, and it is an infrastructure TIF only, but we have to come up with the capital to pay for $400 million of water, sewer, roads, bridges, and then ultimately we get paid back, assuming the tax increment increases. So that's where infrastructure here, and hopefully with the federal funds that will be coming, that will be helpful for Chicago. But I worry about some of these other smaller markets that have just exploded, and many of them do have capital to pay for the infrastructure, but it's a heavy burden.
I think the way you design your buildings has a lot beyond the touchless and let's call it the COVID adaptations, and we'll see how durable those really are. It's like the handshake that's never coming back is back. But I think when I look at the building we're going to build at 170 North Green, we have large floor plates. We can divide them in different ways. We can re-demise them. It's very flexible space. We have a tenant who can take a full floor. We can have a tenant who can take a quarter of a floor. That gives us some opportunity to shift things around there. I think some of that in thought and design of how flexible you can make your space will allow, adaptations as the market changes, because what looks great today in 10 years will be, yesterday's building, and it won't be the hot thing. But, that's one thing I think we're trying to focus on.
I think at Hines, we're leaning into our T3 concept, which is our timber development, in a big way, and I think we're seeing, to Keating's point, on tenants being their penchant for paying a higher rent, and the exit cap on those developments is really incredible to see, even for office. So we've got our T3 concepts in Minneapolis and Atlanta currently. We've got a site in Goose Island, doing it in the Rhino District in Denver, and there's all kind of, they're in these warehousing districts that are transforming over time, but we're really leaning into timber. Just overall, it's a great product. If you ever get a chance to tour it, I strongly recommend it. And then on the industrial side, we're doing a lot of innovative things with solar, net water positive buildings if we can, leaning into the ESG angles on an industrial development. It's not easy. But one of the interesting things we've done on urban infill sites is put the car parking not the trailer parking, but the employee car parking on the roof. So have a reinforced roof and having the car parking with a ramp that goes up and allows the entire front of the building for industrial docks. So there's no commingled car parking and truck parking. And then on top of the roof, where the cars are, we would have solar panel awnings to cover the cars as well. So we've actually done that in the Netherlands on a very site. Land there is challenging to develop on as it is, so we had to come up with innovative solutions on how to kind of push forward. And if COVID was any implication about where we're going from expectation of packages on time, from a delivery standpoint, I think these urban infill last mile centers are going to be very unique looking. They're all not going to look the same, but they're going to be in very high demand. And getting that piece of the puzzle right from a supply chain perspective and offering tenants that not only an environmentally friendly industrial building, but one which is very functional and maximizes that door to what is increasingly being a cubic foot ratio, I think is going to be critical.
Well, I know the other day we said we weren't going to talk about parking, but since Omar opened the door, getting those, and now I'm just talking about residential or multifamily and office really, but getting those parking counts right, I mean, it's really a jump ball right now as far as I'm concerned, and looking forward the next 10 years. I think for a while in Fulton Market, we were overbuilding parking because we felt that we needed the parking to get the cars off the street. Then there was a big, maybe overcorrection to underparking because if you build it, they will come. And now we have this, public transportation is being used a little bit less in certain places because of COVID, and so more people are driving. You can't even buy a car because there's so many out there in use. So I don't have an answer, and I think we're going to make a lot of mistakes in the next few years based on whichever end, wherever we end up, and then add in how many car chargers should you have for a 400,000, 500,000 square foot office building. I don't know.
I think you put your finger on the issue. Parking, all cities have, transit-oriented development policies. They discourage parking, especially when you have great public transportation systems like New York or Chicago and others. And then suddenly no one will use the transportation system and everyone wants to go back to the office, but they'll only go if they can drive. So, how do you build that parking so you can, none of us know the future of electric vehicles. We all think that's coming, right? So you're right, how many car chargers, how many do you have to put in? How will that work in the long run? I think, keeping the space flexible is the best opportunity. Can you convert parking to retail or something else? But I think you guys have put your finger on it.
No, I think that one thing we would say is that the way the transportation works, right, from the office worker to the retail customer, industrial, it will definitely be different than what it is today, right? That is I think a given. So which is a great opportunity, right, as well for development in many places where there is a surplus or will be a surplus of parking. At least that's, the theory in the retail world, given how much over retail there may be, right, in some of these markets. So we'll see. But I hear you, David. I think that investing today for that flexibility, right, and understanding that you're not just building for a single purpose, like we may have, for many years, but understanding that it could switch, and not like in 20 years, but having that ability to either add solar panels, add additional weight, do a speed ramp up to the roof, whatever it may be, is worth that investment, during that construction, and just to have that the opportunity to be able to change.
Yeah, the problem with merchant builders obviously is that they're building for today and for a sale, so the long-term value owners are going to have to demand more of that.
Yep, agreed. Well, excellent. So I'm going to do some rapid fire questions here. Some more ones. You guys look nervous when I say that, so that's good. And then we'll open it up for questions from the audience. So what have you seen as a positive for 2021? 2022. I'm in 2022. Sorry, 2022.
I think going back to General Mattis, just the Eurozone coming together in a way that they haven't before is, I don't think we appreciate how huge that is. Europe as a body of policymakers was largely ineffectual the last 15 years in what they brought to the table. And I think this war, the silver lining, has brought Europe together in a way that I don't think I would have ever predicted. So I think it's going to have huge ramifications down the road that we're not thinking about.
Thank you.
So Mattis also said that if you think you're the smartest one in the room, then you're in the wrong room. So I'm not going to go that deep. And I'll keep it closer to our topic. But I think the increase in occupancy getting into the 30s is a huge move. And it's given the continued unknown with people still coming back to the office, is the unknown's out there and people are still coming back to the office is great, and I think it's only going to continue.
Yeah, I mean, I'm keeping it in the narrower view of things. I think, there is more of a normalization occurring now. If you're out and about Chicago in many neighborhoods, it's active. Restaurants are getting fuller. People are going to games and shows and other things, and it's great to see people travel again. And I think that all makes me feel a little bit better about everything.
Fantastic.
I would just add I had 2 Justin Bieber concerts canceled on me in 21. I was going with my kids, but I got
About your kids.
But I finally got to go with them.
Fantastic. And was it everything you hoped it to be and more?
More, way more.
More. Fantastic. Exactly. We'll do a poll of who else has gone to a Justin Bieber concert later, so with their children.
This gets pretty small in this crowd.
I love it. Okay, so again, looking forward, right? I'm very jealous of the 30 to 40% lease spreads that industrial has been bantering about today. Who are the winners and losers in all of the different categories? Forward-looking.
I think
Your prognostication.
Yeah, I think industrial, multifamily, and the Sun Belt continue to be just the huge winners, and that's really no surprise. And I think there's some runway in each of those categories and geographies to kind of continue to do so. It's just kind of simple, follow the numbers.
And who you go positive, who else do you think is going to continue to struggle? If you can.
Yeah, enclosed malls, it's no different than it was 12 to 18 months ago. Class B CBD office, suburban office that's not amenitized or isn't in kind of a town center area, I think will continue to be very hit or miss and struggle. And then, one thing that we're watching now with rising rates and inflation is the glass ceiling on rents for Class B and C multifamily, and how, with the stimulus money running out, the ability for those tenants and renters to handle significant increasing rents. You've got a lot of inflation doesn't, it affects OpEx in a big way, and you've got rising insurance, rising property taxes, rising salaries and wages, rising R&M, and for Class B and C tenants to bear the brunt of those rising costs, I think is something that we're increasingly cognizant and watching.
I think the winners in all of the use categories are going to be those that continue to innovate and push the envelope. ESG, design, amenities. There are too many creative, smart people and companies that are willing to spend the extra dollar to put out a superior product. And if you're kind of steady state, you're going to lose. And I'd also add the cities where the tax system is predictable will continue to grow. Where there's unpredictability, it's going to continue to be a real struggle, and that obviously impacts everybody.
That's great.
Well, I think the winners, we all kind of know what the winners are. I mean, I worry about the potential losers of urban neighborhoods, urban retail, affordable housing. These are really challenging issues for cities. I think Fulton Market will be just fine, to be honest. I'm not worried about Fulton Market, but I'm worried about Englewood. I worry about what happens in places like that where, you know, we lose a key grocery store, and, you know, what happens in a world like that. So, you know, in the world of commercial real estate, I think we've all found a way to navigate it. Industrial is very strong. Even, you know, I heard, you know, the run to quality or the move to quality or whatever we've used as the term today. I mean, strong, you know, good assets will continue to perform very well, but the rest of the city and the, you know, the rest of the areas of the cities are struggling. We need to come up with a solution because things will only get worse, and the discrepancies between the wealthy and the not wealthy will continue to be exacerbated.
Well said. Well, thank you. I appreciate all of your insights and information sharing. So at this time, I would like to ask if there are any questions from the audience. Yes. Oh, she's got one over there in the far corner, please.
It's going to take him a while to get here.
Yeah, perfect.
So I do affordable housing development, and we have a property with a child care center on the bottom. And I'm curious, as we talk about amenities, I would think daycare centers are one of the big amenities that would bring people back to the office. Is that something that's discussed? Is childcare or even senior housing for people who might otherwise be forced to be home with family being discussed, and what, if any, city or other governmental programs are there to potentially encourage the ability to put those kind of facilities in some of these buildings?
I mean, I think it sounds like a very smart idea. I think, you know, when you get to a certain point, kids are going to school, but I don't know if you're doing that in any of yours. I don't.
We've talked about it a little bit in office buildings. You know, from an office perspective, there's always been, most developers have always shied away from an entrance that has childcare right off of it, or if there's a school in the building, the entrance, you know, having the same entrance between the business people and the students. But I think it can be done really well. I think on the affordable housing side, we need to continue, at least in Chicago, to encourage development so companies like ours are paying into the Neighborhood Opportunity Fund. Because the more market rate projects that get greenlit and go, it's hundreds of millions of dollars that go into and a lot of the Southwest sites are using at least some amount of Neighborhood Opportunity Funds. So it shouldn't be frowned upon greenlighting a market rate project, because that's, you know, can be $5, $10, $15, $20 million that's going into a fund that can help affordable housing. It can help invest Southwest projects, and it's as I mentioned earlier, it's a great tool.
I think it's a great issue, by the way. I don't know the answer. I will observe that this morning we talked about adding the amenity of a place to bring your pets, but we didn't talk about a place to bring your kids. So maybe we should be thinking about it a little bit, you know, a little bit more than we have so far.
Solve your sibling issue.
Exactly.
For sure, separate them.
Just bring them to work.
Well, and it also goes to just the ability to hire talent, right? Obviously, a lot of women, right? The statistics are that they left the workforce for the last couple of years, right? There's as great as men are in helping to take care of the family, the majority is still on the women, and as they were going through the last few years. So I think that having childcare opportunities that are affordable and allow some of those flexibilities is something that either subsidized by employers, right, but have to be actually available in a convenient manner. So it gets to an interesting approach as to who is the target, right, for that person. So.
One thing to add real quick to that, we haven't done it in office buildings, but we've put small daycare centers in some multifamily projects. But one place where we put it, and we found really outsized results, is we put it a daycare facility in an industrial park that had a massive amount, really large, about 2.5 million square feet. There's 120 tenants, and we put a daycare facility, and the amount of positive reaction that we got from that was incredible, because a lot of these workers work odd shift times, and we found an operator that had an extended care daycare facility, and that was huge. And then it had a trickle-down effect, and tenants wanted to be there because they could hire workers easier because we had this amenity at our park. We now have a waiting list of tenants to get into the park because of this facility, which is being a magnet for labor in a way that we didn't foresee before.
Amazing. Fantastic.
That was really a great question, actually. I just wanted to quickly, there's a session coming up. We're concluding with a session in a minute on ESG, and you guys kind of got at it a little bit, but I'm particularly interested, and I know up front, ESG means different things to different people, so I get all of that. I think there's a sort of a social dimension to it, and I actually think that what you're mentioning gets at that as well. So here's the bridge, and the bridge is, what are your ESG priorities? Whatever you understand ESG to be, what are your priorities? What is your leadership team telling you ought to be the priorities, and how do you intend to implement them?
And one of the things I'm just going to layer onto that, how is that affecting your investment decisions as well, right, when you're presenting a committee?
I'll accept the friendly amendment.
Fantastic. There we go. I didn't, because we talked about that question, so that was great.
Well, I think there's a lot of practical answers to that. ESG does mean a lot of different things, and probably should mean, even more. Like, we invest in a full team to deal with sustainability for every project, every single client we build for, every spec building we do where we're going to be seeking tenants. Those tenants are going to demand that of our projects, that in our buildings that we're dealing. That we also, I don't know if your question goes to things like policies of your organization, how you promote people, how you do, how you promote equity within an organization. I think these are all different things. I think that's a significant focus for us in every aspect of what we do. It's our ethos, for lack of a better term. But I know it means different things for different people beyond simple carbon neutrality or something along those lines.
So, I mean, we're I think, at about the same stage that David is. I'd add, both, in our corporate office on diverse hiring is a major initiative, but then also, and not just because here in Chicago we have to do it, because we're exceeding all of our goals on minority and women-owned business hiring on the ground in the projects. And again, it goes back to kind of what I said before about continuing to innovate. That's on the environmental side as well, and both from, we haven't done timber yet, but we'd love to, but on the sustainability of the materials that we're using, as well as advanced systems, both on redevelopments and replacing antiquated systems, but also on newer projects.
Yeah, it's ESG is kind of integrated within Hines, really well right now. We have created a global head of ESG. We have a chief carbon officer. His full-time job is thinking about carbon reduction, and I think between the two, and then we have an entire ESG team at Hines, promoted heads of DEI. We're tracking inclusivity hires on a monthly basis. At our officers conference last week, all the vendors, similar to Keating, were minority-owned, women-owned businesses, and even the performers, speakers, just focusing on it, just top to bottom. Even at a conference, how can we, bring in that ESG angle, that DEI angle to resonate with all of our employees? And so I think the environmental and social pieces are kind of where we're focused on. I think government's a little bit loose right now, and what that means. We've obviously got a board of directors that we've incorporated, and that kind of overlaps with social, but I think governance and policy, I think, is a bit of the squishy side at the moment on the ESG, and I think working to the best we can on defining what we've been doing the last 12 months is really defining the 6 criteria in E, S, and G that we're going to be focusing on.
And I would just add to that, we're all doing it because we should be doing it, and it's the right thing to do, but our investors and our partners are demanding it. And they're demanding that our reporting is better than it's ever been, and they're holding us to task. I mean, 2 of our largest partners, Topher Merrill spoke this morning at from Harrison Street and JP Morgan. They've absolutely demanded it.
I think for every starting this year, every investment presented to Heinz Investment Committee has to have an ESG page. And so it's fully integrated now.
And for us, I would just add again, dedicated ESG, right, individual being able to report out. I think on the retail side, it does get interesting because we're an open air center, so slightly right different as far as what we can control. But we've started to also look to some of our major retailers. And if you look to Walmart, right, who's been doing ESG for 15 plus years, what are their best practices as well? And I think part of that, again, is being able to reach out, have understanding on, okay, waste diversion, right? And what does that look like across the board? And really figure out ways to work with our retailers in different ways so that we can be more successful as well in figuring out where we can move the needle, right? And I think that's pretty exciting as well for the Open Air Center. Okay. Thank you for your question. Anyone else? Okay. Well, appreciate it. This was a great opportunity. Glad to be able to do this in person. To your point, a sense of normality again. And thank you, everyone. Take care.